is on mining, taxation on mining. How is tax on mining computed? So we have the question which is there on the screen and want to see how it is done specifically in Zambia, since tax is mostly according to the region on which you belong to. So this video is focusing on how tax on mining is treated in Zambia. So we start. Mulundu Mining Corporation, MMC, PLC is a Zambian resident company engaged in the extraction of copper on the Copper Belt province of Zambia. The following is a statement of profit or loss for the year ended 31st December 2020. We have the following statement, as we can see. Now, note 1, of course the notes will have to follow them. Then there's obviously an adjustment for that. Yeah, and basically we want to see the additional information, which we'll be analyzing one by one in order to understand the information. Yeah, so we'll get started with the first. Before we get started, the additional information. So we have about 7 points. Actually, they're about 9 to 10. Sorry, 10 is just a formula, but they're about 9 workings that we would have to look at. And then the required, always check the required before you do anything, because it will guide you on what to start with. So the first part is saying compute the taxable mining profit for MMC PLC for the tax year 2020. B, calculate the amount of company tax, income tax payable by MMC PLC for the tax year 2020. So we want to do this. We're starting with the computation of the taxable mining profits. So of course they've included so many things in their expenses, their incomes, but some of those things are not even allowable according to the normal tax and according to the business profits that are accepted. So we want to fish them out and look out for those which are not allowable and account for them in the following statements that we're going to prepare. So that those which are allowed for tax purposes, they will just be left, we won't touch them. But those which are not allowed are the ones we want to fish out, because we want them to be according to the tax authorities' satisfaction. So let us start from the first one. There it says the amount of revenue in the statement of profit or loss is the norm value for mineral royalty tax purposes. The copper prices are quoted by the London Metal Exchange averaged 5,800 per ton throughout the tax year 2020. They have told us something. Revenue, the revenue there that we saw here in the profit statement, they said that it comprises of what? The norm value of mineral royalty taxes of these copper prices, which are now averaged at what? 5.8 per metric ton. So what you're going to do is this. There's a mineral royalty that is included in what? In the revenue there. Okay. So what we're supposed to do is we need to calculate that mineral royalty tax, because the rules in mining are as follows when you're calculating mineral royalty. Mineral royalty, if you can take note, is that this is just a tax that you pay, okay, for possession of mining minerals. Basically, you're supposed to pay some tax. So now this tax is usually paid on the quantity and obviously the amount sold, okay, and the amount sold. So here do we have the quantity? Yeah, okay, they just said the dollar there. Now, and also they said and the amount, so that's according to the rules. So you can also check the selling price. That's why you can also charge where the sales, in this case, or the revenue. That's why you can equally charge the mineral royalty tax. So just remember, it's either on the quantity and also on the revenue or the sales, which is the revenue in this case. So basically, that's why we're going to charge the mineral royalty, so that we can calculate that mineral royalty tax that should be seated in that. That is based on those sales that they have incurred here. And just to not even go far as such, the norm value, as they have stated there as well, that's another guide to show you that, okay, mineral royalty tax is also charged on what? The norm value. So the norm value could be, as we said, that quantity there and the sales being the revenue. So what we're going to do is this. How do you calculate mineral royalty? Well, the categories depending on the metric tons that you have here for this metal you're looking at. Here it's 5,800. So I'm going to take you to a chart where you see the percentage we're going to charge. This chart you're looking at is the chart for mineral royalty. Remember the metric tons we had in point 1? 5,800. which category do you think they'll fall in? Under which norm price there? So we have 4.5 there. Okay. Then we also have 4.5 to less than 6,000. That could be our category actually, 4.5 to less than 6,000, because that one's 5,800. So therefore, we are going to use the rate in this category to find the mean royalty tax. And it's going to give us what here? Let's go and calculate it. So here it's going to be like 46,000 million, sorry, by 6.5. So you charge 6.5%, as you are seeing, on the 46 million, because they said the revenue itself is the norm value, and we said we charge mean royalty or norm value. If you remember my latter statement, or the last statement I mentioned, so there is your answer as the mean royalty tax that you will pay on this copper. So mean royalty tax is not supposed to be subject to those profits that you record as your business profits and the expenses. No, you're not supposed to put it there, because this is just tax that should be wholly paid and not expensed against your normal business profits. No, you're not supposed to do that. So since then it was there, the sales there were included, therefore we have to add it back. So as I said, we're fishing out those things which are not allowed. Those are the ones we're coming to add back. So here we've been told there's royalty tax based on the norm value there, so that's the one we had to calculate first, and then we add it back, because royalty tax is not supposed to be initially there. That's what we're doing. So this is your mean royalty. You can record it, and I'll show you in the final part of everything. The next adjustment we'll look at here is, well, number 2. Cost of sales include mean royalty tax, depreciation charges 1,400, and amortization of intangible assets is 300. The balance consists of revenue expenses, which are all allowable for tax purposes. Just a statement there. What things are here? Depreciation. Depreciation under normal circumstances is supposed to be what? Added back. Why? It is not allowed, okay, in the computation of the taxable profits. Yes, so we have to add it back. Only capital allowances are allowed. That's why whenever you just see depreciation, we have to add it back, because according to the taxman, that is not allowed. Okay, there's a provision which the taxman calls capital allowances. So hence we just see depreciation, add it back. We're coming to add this one back. And another one is amortization. It's just another way of phrasing depreciation. If you remember your financial reporting, this should be intangible assets. Yeah, and it's 38. So this is just depreciation on intangible assets, basically amortization. Okay, then the rest are allowable. That's it. We skip 3. The operating expenses include the following operating expenses. So there was operating expenses somewhere in your initial profit statement. It's there. Check the even saying not 3. Check not 3. So these operating statements expenses, some of the things in there, that's the guidance, some of the things in there are not allowed, and want to fish them out as well. So salaries and wages, these are allowed as long as just normal that's for the purpose of the business. Salaries should be paid to workers and the like, and if they're just generalizing everything, then it's allowed. Entertaining customers and suppliers, this specifically is not allowed. Why? This is because you're entertaining these are expenses to third party. Okay, these are just those that are not necessarily part of your business. Yes, customers and suppliers, yes, we do trade with them, but they say these are like third party to the business, and such expenses that you incur on them, they say they are not allowed and they should be added back in the following, as I said, computation that I'll show you at the end of the day. So just remember, entertainment of customers and suppliers is not allowed. What if they said staff or employees? Those would be allowed. Those are allowed anyway, because those are there. They're not necessarily the third party employees. Okay. Construction of link road within mine township. What is this? Yeah, a link road within the mine township. So mines are located in certain places, then they would also construct some roads. This one specifically is like CSR, it's a corporate social responsibility, and they say mining, it's like the responsibility to do such things in the areas where they're operating. So they can claim capital allowances on such things though, because they're benefiting of course the community as a whole. So they will claim capital allowances on those any constructions that they help in schools, whatever, whatnot, but only limited to 20%. So we will calculate at some point when we start dealing with the capital allowances. But the rule is that they're just supposed to be these figures. When they tell us these details, we're just supposed to come and calculate capital allowances and bring in the capital allowance total. But the fact that they are in operating, they've put them in operating expenses, meaning somehow they're giving you a wrong profit figure because they're not supposed to be there initially as well. As I said, these figures are just supposed to be a statement given so that you can calculate capital allowances and just come and show them under, just come and show the capital allowance calculations. But the fact that the actual cost of whatever they spent on the link road is there in the operating expense, then there's a problem there. We have to add it back because it's not allowed. So we can move. Construction of community hospital within Mine Township, same story. Community what? Hospital. This is CSR again. Capital expenditure will be claimed. It's 20%. Other revenue taxes are allowed. Okay, so the rest, if it's allowed, we don't even deal with it here. What we're dealing with is things which are not allowed. Let's go to number 4. We move on to number 4. The interest expenses were incurred on loans from Zambian financial institutions which are not related to MMC PLC. The interest expenses amounted to 20.53% of the profits before interest, tax, depreciation, and amortization. So this interest, are we going to add it back, or is it, let's say, is it something that is allowable or not? So look at what they have said. It was incurred on loans from a certain financial institution, right? That's why the expenses, of course, came from the loans, of course, that they initially had gotten from this institution. Then they've just added the point that yes, this institution is not related to MMC. So therefore, I think this is for the purpose of the business, okay, and hence we cannot add it back because it's something that's allowable. These are expenses that you're incurring for running your business. Okay, so the things that they usually do not allow are those which are not wholly and exclusively for the purpose of business. Those are the things that we end up adding back because they're not, that wholly part is not being checked. Yeah. Then number 5, other income include profit on disposal of old mining equipment, 120,000, royalties, 340,000 net, and dividends from Zambian non-mining companies at 140,000 net. Withholding tax has been deducted at source where appropriate. So what is this here? We have some other incomes. The ones that are showing the statement, they are including these things we've told us. Things like dividends, royalties. When you see, when you see these things, these are what we would call investment income. Royalties, dividends, consultancy fees, those treasury bills, rent. Okay, most of those things are investment income. Now, how do we treat them? Okay, these, they are subject to what? Withholding tax. Mainly, all investment incomes are subject to withholding tax. So, first of all, what we're going to do is this. These items have been included in your other incomes. I've said that's not number what? Okay, so they've just told us something about our other incomes. Yes, not number 5. Yes, not number 5. They said those things are there. So the fact that they are affecting your profit, first of all, you just have to come and subtract them because the rule is that these incomes, they are not supposed to be parts of your, should I say, your normal business profits. They are, as I said, they are subject to withholding tax. With their own separate portion. So if they are included like the way they were included in other incomes, the rule is just that come and subtract them in this computation of the taxable mining profit. Then at some point we'll come and deal with the withholding tax at the end. So take note of them. The same figures they have, 120 or 340, we're coming to come and include them under the items that we're going to start subtracting in the computation here. Number 6 is the amount of income tax expense represents the provisional income tax paid during the year ended 31st December 2020. So what have they said? The amount of income tax expense represents the provisional income tax paid during the year ended 31st December 2020. So you can have a look at it. The one they're talking about, the income tax, yes, that's not number 6. Not number 6. They've told us this income tax expense of what? 2526. Okay, so usually they say this if it's part of your net profits. Usually the net profit that we pick is the one which is before tax. That's the one which we usually start with in our computation of taxable profits. So if it's not, if the figure is part of that net profit before tax, then you have to, and it's not allowed, then you have to come and add it back, like what we're just doing, the fishing out those which are not allowed. Now the fact that this provisional tax has just been shown after the net profit before tax, if you can see there. Therefore, there will be no need to come and start adding it back here, although the rules state that any provisional income tax expense, it should never be part of your net profit before tax computation. Okay, yeah, that's just how it is. It should never be there. But the fact that if your calculations are going to start from net profit before tax, then you know it's not there. You can't start adding it back. You only can start adding back what is not allowed if it was part and parcel. So basically this one, we're just going to take note of it. We're coming to deal with it at the end. On the 1st of January 2020, MMC PLC had a tax adjusted loss incurred during the year. It ended 31st December, amounting to 3,600,000. When you have a loss, what are the rules? Well, let me just share the screen. So what we're going to do about the mining loss is that they say that you're supposed to index it first. Okay, you index the loss that you have stated as a company that we had this loss. So you say you come and index it in this formula here, R2 minus R1 over R1. So where R2 is just the rate in the year that you're claiming this loss relief, that's the R2, and this is basically just the current year if you want. Then R1 is just the preceding year, the one before. So the one before is R1, so there will be always a rate from the previous year and a rate from this current year, and that's basically how you would look at them. R2 is just the current, R1 is the previous. Then the answer that you would get, then you multiply it to what? The loss that they've stated, which is our 36 in this case. So what is R1 and what is R2? Let's go to the question. So basically these R1 and R2 are just the BOZ mid-range mid-exchange rates. Okay, so you have the 2019 and 2020 rates, the same thing I was telling you, they'll give you 2 years. So this one, we're computing tax profits for 2020. Okay, sorry, I beg your pardon, I just shared a wrong screen. So that one's just on another question. So the one we're looking at here has got these 2 rates, 13.8 and 14.4. 2019 is 13.8 and 2020 is the 14.4. So we're going to use R2 being 14.4 and R1 being 13.8. Then we compute our loss, the one that we'll index, the indexed loss, that's what we'll call it. So we said R2 is 14.4, while R1 is 13.8, or minus 13.8 over R1 13.8. Close brackets, 1 plus that times the loss that we have is 3,600,000. What other answer are we going to get here? 3,756,522. So there are some rules once you index your loss. They say that this indexed loss, is it more, okay? Is it more than the taxable profits for this mine? We haven't yet found the taxable profits because that's the one we're trying to compute by analyzing all the notes and the adjustments, in short. So at some point we'll come and wait for this decision rule, but what you can just know for now is that they say that if you discover that this loss is more than whatever taxable profit you have, they say you can only relieve up to half or 50% of that profit that you will get. That's how much you can just come and show as a loss relief. Just go and say whatever, let's say you have, as an example, you have 10, we end up with 10 as our taxable profit. Half of that is what? 5, right? That's when you just come and write that, okay, the loss relief will be equal to 5. That's how it will be limited to. But in a scenario where it's less, let's say it's less than the loss that you've incurred. Yeah, so in that case, if it's less, because let's say if it's less than your profit that you'll find at the end of the day, right? We'll still ask ourselves this same figure, okay, it's less than the profit we'll find, but is it also less than 50% of the profit? Okay, those are the questions we'll ask ourselves. So let's use the same 10 example. We had 10 as a profit. Suppose our loss was 11. We'll be like, okay, this is more. Therefore, whatever we're going to relieve will just be half of this 10, which is the taxable profit, as 5, and then we relieve the loss. Then, suppose we have a loss of, let's say 8. 8 is below 10 now. You'll be saying, oh, okay, this is below. What are the rules again? If it's below this loss, what you're supposed to do is this. They still say, if this same loss is more than 50% of that taxable profit, which is 5, as we are saying, it's 5, that's 50% of the taxable profit. Now, it's a short example here. You're just supposed to relieve up to halfway, nothing more than that. So you can only relieve your entire loss that you have indexed if it's even below the half. Let's say your loss was 3. It's below half. Therefore, you can just come and relieve the whole 3. I hope those rules will be taken note, so you can just rewind just to polish up that part. Yeah, so as earlier stated, we will come back to that loss because it comes at the end after you found your taxable profit. That's when that decision rule even works well. But I was just trying to give you an overview. 8 specifically is now on what? Capital allowances. We want to see what capital allowances you claim from these items. So just a minute. I wanted to finish with those things that we're adding back before we get to the capital allowances, because then they come under subtractions. So take note of this other one. Note 8 at the bottom there. The Toyota Fortuner car and the Toyota Prado car are used by the Chief Executive Officer and Operations Director, respectively, on personal-to-order basis. The private usage in the motor cars is estimated to be 45% by each individual. Yeah, so this statement here is showing us that these two, the operations director, the CEO, they have vehicles, personal-to-order vehicles, that they partly use for the business. You see now. That's why they're saying 45 is the private, and of course this other part is obviously for the business, the other 55%. So yes, the rules are this. This is a company. As long as it's a company, it is a mining company actually, to be specific. As long as it's a company, the rules are that private use is neglected. The fact that you're using it partly for the business, it will be just assumed that all of it is being used. There's nothing like part private, part water. We just assume that it's entirely there. We do not divide in a company unless it's on an individual's business profit computation. Then we'll be like, okay, just focus on the business portion. Take note of that point. So here we're just going to go and understand that, okay, they use these vehicles what for the business. The fact that they use them, they will be considered that they were used. And what are the rules? They say that we are supposed to add back how much? We're supposed to add back the expense according to their cylinder capacities. What are the cylinder capacities on these vehicles? We have a Fortuner 3000 cc, Prado 26 cc. How do you do it? There are rules. Let me just show you on the next screen. So this is basically the range we look at. All vehicles less than 18 cc, they add up to 18,000 expense. That's what you add back. All vehicles from 18 to 28, 30,000. All vehicles from 28 and above, sorry, not 28 and above, just above 28, it's 40,000 kwacha. So take note of the ranges. Not the other one is from 18 to 28. The other one is just above 28. It's 40,000. So those vehicles, one of them is 300cc. It's in this category. The one I've ticked. The other one is 26. 26 is in which category? Here I'm putting a star. So one of them will be put at 30,000. The other one will be put at 40. That's how you get it. So the Fortuner will be put at 40 because it's 3000cc, because of the category it's falling in. Whilst the Prado, which is a 26cc, will put in the 30,000 category as the expense will add back, and we'll even put their details as you will see soon. So now we can go to the capital allowances. This is now the largest bit of the items that we also subtract as we are computing business profits. So I would like you here to just at least pause, maybe take note of the figures, because when we go to the next screen, it will be just a matter of you trying to maybe recall from what you've written, because I want to just share the next screen while now do the computations of everything. So I'll just advise you that take note of the figures so that as we go to the next page or screen, you are just able to follow through. So we're beginning now. So we are on the capital allowance calculation. That was not, that should be not 8 there. Should be not 8. Yeah, so that's your note 8. So basically we are looking at those same capital allowances that I told you to first preview before we get to this screen where we'll now show the computation. We're starting the old equipment. The old equipment had an income tax written down value of 480. That's just showing you that this is the value that it has as at now after subtracting some capital allowances on it. So the original cost was 24, but it's now left with 480, meaning it's not yet at zero. You can still claim. The point is that when you reach zero, you cannot claim capital allowances anymore. But the rule is that all mining equipment is supposed to be at 20%. Now take note that this equipment was sold for how much? They said below that it was sold for 780. So let me just show you how you deal with a sale. So the ITW, income tax written down value, was 480. Then now you have your, what figure we're looking at here? The sale or proceeds is how you're supposed to write it. Proceeds 780. Therefore, you know you have a 300 here as a difference, which we call a balancing charge. Why are we calling it a balancing charge? This is because you have like made a profit. Usually a profit to the taxman is a balancing charge. And we put in brackets as we put all other capital allowances, because this one is not supposed to be an addition in the capital allowance calculation. And that's the 300 you are seeing on the previous screen. Okay, then you look at other assets like the haulage truck. That's just an ordinary truck. It's not like it's used for mining. They haven't specified. If they specify that this is used for mining, then you charge that 20%. Now they just said it's a haulage truck, so it's just a normal commercial truck. All trucks most of the time are commercial, and they will categorize that as commercial, and it's 25% of the cost. Always remember, capital allowances are always charged on costs, despite them telling you income tax written down value, but we always charge it on cost. The ITW is just there to show you that are you still able to claim more? If it's zero, you cannot claim. So this is why the haulage truck was charged, and you'll see on the next screen. So basically, that's for the haulage truck. You just charge on the cost, and that's the figure of capital allowance. Toyota Fortuner, the cost was 600. You charge 20%. You do that as well. Toyota Prado, 20% of the cost of 450 as well. Office building, this is an office. Ask yourself, why are they using 2% here? An office building is a commercial building. What is the capital allowance on a commercial building? It's 2%. That's why they're using that. New mining equipment, the word mining has come out, mining, so it's 20% there. It was stated as well in the question. Then now you remember those things we were leaving initially in note number, those things which were included in operating expenses. They told us, yeah, that was note 3. They said that there was a link road, the community hospital, those things, they were in the profits initially. So these are the ones that you also have to claim capital allowances for. This that I said CSR, the corporate social responsibility. So these are, you can claim 20% capital allowances on those expenditures of building hospitals, even schools, even roads in the area where you're working. And that's the 2,870,000 you should get as your capital allowance total. By the way, before we switch the screen, remember profit on disposal, not number 5, the one which even had other investment income, the one I talked about. Even profit on disposal is supposed to be an item that you should just come and subtract when you're computing the taxable profit. So of course, even those other investment incomes are also coming to subtract them, as you will now see on the next screen that I'm about to share. So in this video, I started with profit before tax. It's usually even recommended we start with our profit before tax. Then we begin to compute those things I was talking about. Add back, add this back, add this back. All those which are not allowed are the things we're adding back, as you can see, just as we had talked about them earlier on in the video. So this is how you're supposed to present your information. You even put a heading, MMC, PLC, this is the company we're looking at, taxable mining profit computation, because this is the mine, they talked about them. So even add back, start with usually the adding back items. That's the mineral royalty we talked about, depreciation, amortization, entertainment of customers and suppliers, construction of link road. The reasons were stated. You can even just rewind the video just in case you've forgotten at this point. And construction of the community hospital, we talked about this. Personal to order vehicles, we talked about this as well. And we just said we add them back according to their cylinder capacities, those vehicles. Yeah, as long as they were still used for the business, because we don't consider part, we just say as long as they were used, they will be considered that they were used there fully. So that was the additions. Then what about those things we're subtracting now? The profit on disposal, the one I talked about, 120. Royalties, these are now the investment incomes. Dividends equally. and the capital allowance figure of 2870, the one I just told you earlier on the previous screen. Once you deal with all these things, these are the things according to this question that need to be treated for the taxable mining profit purposes. Therefore, you have your figure waiting for you, the 17,980. Since this is less, we are going to subtract as this line is showing us there. Subtract and we end up with 14,510 as this is supposed to be our taxable mining profit. Okay, now we won't end here for this question. Why? Remember there was that loss I talked about. So whenever you have a loss, do not just end on, okay, I found the taxable profit and you move on. Ask yourself that row on the loss that I stated earlier on. Is the loss more than what? Is this loss more than that 50% of the taxable profits? Is it more than 50%? So we're going to calculate. Remember your profit here is 14,510. Let's go to the next screen. So 14,510. What is 50% of this figure? This was our profit. So 14,510 times 50. This is giving us 7,255,000. Okay, that's your halfway figure on this tax profit. What was your loss? Indexed loss. If you recall, we found 3,756,522. Is it more than half this loss? No. The rules state that if it's not more than half, you can just offset the entire loss. You can just subtract the entire loss. Now, if it's more, your loss is more than half, what do? You only limit it to half. That's what they say. So these are the rules that you have to understand. As I was explaining the 10, where I was saying suppose you have 10, just rewind and get back that scenario again. So basically, we're just going to come and subtract the whole 3,756 as you will see on the next screen. So that's the loss I was talking about. You will indicate less loss relief. It comes at the end of the profit. So that's why this one is dealt with until the very end, because it's a comparison with the taxable mining profit that you have found and the loss that you have indexed, and you want to get to compare that. Okay, this is the scenario, and then you deal with it accordingly. And that's our taxable profit, the 10,753,478 now, which can be subject to income tax now at this point. We can now start charging the taxation on this. So as we will move on to the next step, which is calculating the income tax for this mining company, let me just explain one or two things. So there's what we say that under those investment incomes in Note 5, there are some of them which are final and also not final. What do they mean? Those which they say is final, then withholding tax is the only tax that can be subject to them and nothing else. That's what that means. And then these ones which are what? These ones which are not final, they'll go through withholding tax, one step, then they also go through another tax system. So that's what they mean by not final. And there are examples of those investment incomes which are not final, e.g. royalties. Royalties are not final. Okay, whether it's for companies, you look at maybe even individuals, their royalties are not final. So they are coming through for further assessment. And as we take them for further assessment, they say that just ensure that it should be at its gross amount. Take note that they put it as net, meaning we have to gross that figure up. We have to gross the figure up and find its gross amount. Then from there, of course, then we'll treat it in the normal other tax way that's going to be treated. So first of all, we want to group in all the incomes that will be taxable. Okay, all the incomes that we are going to apply some tax on, which is the taxable profit that we had found initially, the 10,753, after of course we list the loss and the like. And then take note that there were royalties, the ones I said, there's specifically some investment incomes that are not final. And in our example, it was only royalties. And the royalties, since they are not final, they are coming through for further assessment. So therefore, we fish them out as well. And remember, they were at net. And they say you're supposed to take them at their gross amounts. So you should just know that, okay, royalties, usually the withholding tax on them is 15%. But to gross the amount up, they use the fraction 100 over 85. This fraction helps you to gross an amount that was initially at its net value. And that's how we found the 400 there. So initially, just put in all the incomes that will be taxed yet again. And royalties will have to come through again because it's not final. The withholding tax on it is not final. Hence, we have to equally put it here. And you show this is what you're supposed to be showing your lecturers as you're answering on your examiners. Then you now go into the tax application now. What is the tax on mining profits now? It's 30%. This again will be given to you in any question. They'll give you in the intro of the paper somewhere or at the back that these are the percentages. So 30% is on mining. You do that, you even get the 3,226,000 they're seeing there on the screen. When you look at tax on non-mining, this is also have to be looked at. These royalties, because it's equal income. As I said, it's investment income. It's not on mining, but it's just other incomes that you have. So the fact that it's part of this company, it will be subject to the company income tax of 35% for any company. That's how it is, the tax rate. So we charge 35% on the 400 and we get the 140. So this is what we mean by it's subject to further assessment. The fact that it's not final, this is what we mean. It will not just end on the withholding tax. That's it. No, this is the further assessment we're talking about. It's even subject to the withholding. It's even subject to this company tax there. Then after that, we are computing them together. The total tax on the two is 3,366,043. Do you recall the provisional tax I had talked about earlier in the video? It comes back here. It was paid. You paid some provisional tax. So usually what happens is that provisional tax is subtracted. Why? It's like you've paid something already in advance. Yes, they've come to determine your liability at the end of the day, but you have been doing some provisional calculations, and since you've been paying something, they'll have to at least offset that first, and that's what we're doing here. And you're left with before we find what we're left with, have you seen the 60,000 there? I just did not label it. This is withholding tax. The 60,000 is withholding tax, and let me show you how we got it. So as I said, this 60,000 is withholding tax. It's supposed to be coming from royalties, by the way. So what's going on is that you want to know how much tax you're going to pay as this company, same MMC PLC. You want to know how much tax you're going to pay. You've found the income tax on mining, even for the other incomes, you've put in the taxation there as well. But the withholding tax, they told us that it's this withholding tax, on the royalties, it was supposed to be subtracted. Any withholding tax on what? On the royalties is supposed to be subtracted. This is investment income. The withholding tax has already been taken out. So you cannot again expense them more on it. I don't know if you get what I mean. It was in a net value. So when they say net, then they already removed withholding tax initial system, they mean. So in this case, we also have to take out, which is the 60,000 here. And that's how it came about. And you also have to offset it as well. Then you can get what they'll have as a liability to pay off. Yeah, hence you end up with your 780,043 as the income tax that is payable, the one that you had to pay. And that's how you work out this question.